I got a treat for you tonight. You know what's changed in the last few weeks? Take a look at the stock of United Rentals, the largest equipment rental company in America, with a stock that pulverized more than 6% today alone and wake up an excellent quarter. The last time United Rentals reported back in October, the company delivered very good, but maybe not perfect, but very good quarter, and yet its stock got eviscerated. Why? Because Fed Chief Jay Powell had just vowed to squeeze the life out of the economy with a series of lockstep rate hikes that would have been real bad news for a cyclical company like this one. But even though it's got a secular growth pattern buried within it, we're going to talk about that. Earlier this month, Powell backed away from that plan, and that was a game changer. And that's why when United Rentals reported last night, delivering a solid earnings number on better than expected revenue, up 20% year over year. Terrific guidance. The stock caught fire. It's now up nearly $30 from the lows the day after Christmas. It's like a takeover. Now, earlier this month, United Rentals announced that its longtime CEO and frequent guest on Mad Money, Mike Nealon, would step down in May and become the chairman, while the current chief operating officer, Matthew Flannery, replaces him. So let's dig deeper here with Mike and Matt, the once and future CEOs of United Rentals, learn more about the quarter and where the company's headed. Mr. Nealon, Mr. Flannery, welcome back to Mad Money.
Thank you, Jim.
Thank you. All right, Mike, I'm going to give you a chance because you didn't get enough chance in terms of the eyes of what I think are the buy side to talk about what you created, what you built from when you got there to where it is now.
Well, we've completely transformed the company. You know, if you think about our customer mix has very diverse in comparison, from all construction to more construction and industrial. And now 23% of our business is now specialty related, which is very high volume and also high return assets.
Now, remember, you continue with the acquisition strategy that has really created a national rental company where there was just a regional one.
So as you notice, we're a very acquisitive company. We think that's a core competency for us for integration. We've bought 9 companies in the last 24 months, so it's fair to say we have quite a bit on our plate right now to absorb. But we like the bigger platform, and if we get the right tuck-in that meets the criteria, absolutely we're interested.
But you have to tell people that even though you've made those acquisitions, the balance sheet's as good as ever, and the cash flow is bountiful.
Yeah, by the end of 2019, even with all the acquisitions we've done, our leverage will be back down to the bottom of our range at 2.5%.
Yeah, that's just a juggernaut. Now, Mike, sometimes I look at the company and I think, why don't people realize what it really is a secular change from wanting to own equipment, which is expensive and sloppy, as insurance, and there's big issues, to wanting to rent. And that even though you do have some cyclical up and down, the real story here is the rent economy.
Oh, absolutely. We've talked about this in the past, that the sharing economy, where people are shifting away from ownership. And that's ongoing, and we think that we still have more legs on that to grow the company in the future.
And you've also become much more of a technologically digitized company. A lot of times tech guys come on and say, you can't believe who's digitized these days. United Rental is digitized.
Oh, absolutely. We've put a lot of investment. The board supported us. We're using Oculus for training. We're using digital with all of our employees. We're using GPS to track assets to help our customers drive productivity.
All right, so let's talk about where things are, because there's a fantastic chart. You guys are the most open. I should ask you, you changed your revenue recognition. Some people are concerned, well, Jim, you got to ask these guys, are you changing the way that you report? Is it as transparent as some like?
No, so really what we changed was a fleet productivity metric. People were getting myopically focused on the rate, time.
Yes.
There's a whole other component based on our strategy, which is mix. So all we've done was change and add fleet productivity, which still has rate, still has time, still very important, but adds that mix component, so we see it as a more comprehensive metric.
Okay, that's good, because I felt that your business has changed enough that the metrics should change too. But I've got to ask you, you have real total U.S. construction spending climbing. That's good. But we've got a government shutdown. It's been more than 30 days. I mean, you've got people who are connected with it. We had someone who was on our show, unfortunately, the Commerce Secretary, talking about people, why do they have to go to a food bank? Well, I'm in Summit, New Jersey. Believe me, we had a food bank, and it's unfortunately active because of this shutdown. This shutdown's starting to impact people's psyche. What happens here?
Well, it depends over time. How long does this go on? And we don't know. And to your point, it does eventually affect the sentiment of the customers and employees all across North America. But we haven't seen any discernible impact to this point. But we keep our eyes and ears open to the ground.
And you guys were adamant that even though there's a lot of turmoil, like in December, you said point blank, it is not translated to your business.
Well, sometimes it felt like we were yelling into the wind, but we absolutely have had this confidence. We have 1,200 locations throughout the U.S. and Canada, people with ears to the ground, so we felt confident.
Now, I know that you can't necessarily tell me who you're going to acquire next, but what would be the next? You've got the great mosaic now. Is there any area that you want to be bigger in, both regionally or as an end market?
Matt?
I would say anytime we have the opportunity to add to the offerings to our customers, so new products, new services, is something we'd be most interested in, and that's part of our specialty growth. As far as organic growth, we're very focused on that as well. What's lost in our M&A and very acquisitive nature is in 2018, although we had 20% growth, 10% of that was pro forma growth, so on top of the acquired assets, which we're impressed with. We're happy
that's
with.
one of the reasons why I love your stock. I mean, because like it's so misunderstood, but it seems to be getting moved now. Just a few seconds left. Mike, what are you going to do?
I'm going to be the chairman of the board.
No, come on. I mean, you want to go fishing? You want to play cards? You want to go watch Netflix?
No, absolutely not. I'm still going to be active. I don't know yet.
Do you know that you're young, or is that just somebody else's perspective?
I'm 65 young. Yes, absolutely, Jim.
Well, look, congratulations on everything you did for shareholders. You are a total trooper, always standing by, always coming on good and bad back. Congratulations for you.
Thank you,
I
sir.
wish you both the best of luck, and you deserve it because you're terrific guys. Okay, that's Mike Nealon and Matthew Flannery, the once and future CEOs of a stock that I like very much that I still think is too misunderstood. It's United Rentals. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.